Okay.
So, hey guys, it's Brian over at Cross Country Mortgage. Hope you're having a great day. We have lots and lots and lots of questions about income taxes. So, what I thought I would do is I would have my personal CPA come in and answer questions that a lot of people probably need to know the answers to. A lot of basic things, but I wanted to share this information. Bob's an awesome guy. We've known each other 15 or 16 years, maybe 17 years now, and worked together for quite a number of those as well. And I wanted to just share his knowledge with you guys and make sure that you know that we have resources to help you if you ever have any need for any accounting or professional CPA advice. So Bob, how long have you been doing accounting work?
I have been in the business about 15, 16 years as far as the tax side of it goes. I have been a business owner, so obviously I can talk to my clients on that. I'm a real estate investor myself. I'm a buy and hold guy, not so much of a flipper as too much work. I just like to buy property, hold it, and see the rental income come in. That's my retirement.
Yeah.
So that's really what I do, but my expertise is taxes.
Absolutely. So we work with a lot of self-employed borrowers, and they have all kinds of income issues.
They do.
So, what I like about what Bob and his team do is their understanding of what reality looks like, and they can help plan income for people appropriately so that they're, doing things legally and they're paying income tax on income that we can actually use in the mortgage process. So, what would you say? Well, actually, let me back up. So last year with COVID, there were lots of changes in the mortgage world relating to income. What was the extension date? It went from April 15th to what, July 15th?
July 15th became the new April 15th.
Okay. And
that was both for filing the return and making your first estimated tax payment. So everything that was April 15th, and that was across all entities, whether you were a 1040, a SCorp, a fiscal year. If you were April, you became July for everything. Your first payment and the actual extension date. The state pretty much followed it, not completely. They didn't follow part of it, but they followed it for the most part. But it did create quite a bit of confusion for the taxpayers.
Yeah, that we feel in a lot of those phone calls.
Yeah.
So is that still the same this year? Is it
now this year we're back to right now, and I say right now, right now we're back to what it used to be, which is April 15th. I think depending upon how quick the vaccines get out and if we do get the COVID under control, I don't think it'll change.
Okay.
But we don't know. We have a bill sitting right now in the Senate waiting to go through. Who knows what's going to happen? So we just stay on it, let our clients know. I don't anticipate it, but you don't know.
Yeah, that makes sense. So for self-employed borrowers, something that I see pretty common is they don't file their taxes on April 15th. Their personal taxes, at least. Their filing is pushed out to the extended date of October 15th, right?
Correct. And I'll be honest with you, I am an advocate of filing late and paying on time, because even though the IRS doesn't tell us how they determine audits, they protect it like a squirrel protects their nuts. We have seen anecdotal evidence that if you pay on time, so you pay in April and file in October, your chance of audit is reduced. And for people who are Schedule C, self-employed individuals, they're the #1 audited individual in the country. So we always try to push that to the October, because I feel it reduces your audit risk. You pay what you owe.
So if you owe 20 grand in taxes, you're going to pay that 20 grand on April 15th and then extend it October 15th. And then if you can readjust things on the tax return or have a different outcome, you'll do that, and then they might get a refund later.
Correct.
If they overpay.
But we do feel, and I do feel, that reduces your audit risk, especially with a sole proprietorship.
So that's super important to understand, because I think a lot of people hurry up and file taxes, and then they think that they might get a refund. And a lot of times they don't, and then they have this tax liability they have to pay for, and then they put themselves in the spot where, in my world, I have to have a payment plan for that tax liability.
Correct.
Which then affects how much they can be approved for in the mortgage, because now they have more debt they have to pay for if they just don't write a check for the income tax, right?
Right, and of course we go through the situation where, as a CPA tax preparer, I try to do everything to keep my client's income down to as low as legally possible under the tax code. Then they go to Brian, and Brian says, "What's your income?" "Well, my CPA is really good. I don't have anything." So now we've got to go back. So we have to make sure that we know between us, when is this person looking to buy a home, because we may have to bite the bullet and report some income.
Yeah.
and therefore get a mortgage. So we go through that. Business owners go through this all the time because they want, plus if they're an S-Corp, which we'll talk about in a minute, they don't have wage income like a sole proprietor, like a W-2. So we go through this all the time, trying to play the game between getting the income to a level that will provide a mortgage and also not overpaying your taxes to the point where it's regressive.
Which is what I appreciate what you do, which is why we work together. So there's a lot of business owners, when I first meet them, I get the luxury of telling them that they're denied for their mortgage.
Right.
And then it takes 2 or 3 years for them to finally realize that the advice they're getting is not very good and won't help them reach their goal, which might be, investing in real estate, let's say.
Right.
So what I love about what you do is you invest in real estate, so you understand what we're doing, and the average accountant, CPA, bookkeeper, what have you, that most business owners work with, they don't. So they don't really get what we're doing from a real estate and mortgage perspective. And I think that's super important for you guys to understand. You need a CPA that understands your goals, and if you're interested in investing in real estate, or you're interested in buying your first home or buying a second home, all of those things are questions that should be asked when you're filing your return. When you're preparing your return, one of the questions should be, hey, are you buying or selling real estate this year?
Right.
So here's something that I think this is you started to talk about this, but I hear this a lot from self-employed borrowers. Hey, I pay myself a W-2, but they own their business 100%. And what I want the average consumer to understand is, if you own your business and you pay yourself a W-2, it doesn't matter because you own that business.
Correct.
You are still considered self-employed in the eyes of the mortgage underwriting world. And there are things that you can do that are tax advantaged with your accountant that will help you if you take a W-2 and maybe make it less effort to pay income taxes or what have you. But it doesn't mean that there's an easier way to get a mortgage approval for you. So when like you mentioned, if you're an S-Corp and you are taking you're no longer W-2 basically.
Correct.
So explain that. What does that mean?
So if you are an S-Corp, what that means is your income earned from your business is not self-employment income. It's not subject to self-employment tax. It's strictly income that you own as a shareholder of a company. So for a mortgage underwriter, the problem is, unless you have a very enlightened underwriter, they look at that and say, well, that's not really earned income. That's income you're earning as a shareholder. So what you have to do at that point is physically put the shareholder owner on payroll to make sure that there is a W-2 and there is earned income that the underwriter can look at. And the IRS, actually, we say we have to do that. We're obligated, because if not, the IRS will come back and say, you didn't pay yourself, we're going to put reasonable comp in, we're going to audit you. I've been through a reasonable comp audit for a client, it's not fun. So we always try to do some payroll, regardless of whether they're going for a mortgage or not.
So let's say they're an S-Corp, and I don't want to get too far into the weeds on this, but if they're an S-Corp, and let's say their business profited $50,000 for the year, but they didn't pay themselves any self-employment income throughout the year as a W-2, then they file their return and they basically don't have any income. They have like retained earnings, as an example, in the business of 50 grand. They can't do that as an S-Corp, right?
Correct. So in that situation you're using, they have income as far as the IRS is concerned. They have $50,000 of income, just like they had earned a dividend from Walmart.
Okay.
It's still income and they pay tax on it, but in terms of an underwriter, it's not earned income. It's income from a operation of a business. So what we have to do at that point, like for your case, we're talking about the 50,000, we have to put some sort of reasonable comp in. I use 25%. There is no guidance for that. The IRS, there's no regulation. We just assume that if you are investing in a company and you're taking the risk that a business owner does, you have the right to take some money as dividend distribution and some as wage.
Okay.
If we know in advance, obviously, that we're talking about issues such as mortgages, maybe we do 40.
Makes sense.
Yeah, and of course, and actually you and I had a client like that last year where I would not have had him pay himself as much as I did, but we knew in advance, hey, he needs a W-2.
Yeah.
So we paid a lot more than we probably normally would have.
Which is okay, because you can do that in year, 2020,
Mhm.
and then in 2021, you can take less.
Correct. And he did get the mortgage
Yep.
because
So-
because we did that.
So the key that I want most people to understand is having the right people on your team will help you understand what you need to do to be prepared to reach your goal. So if your goal is to finance a house or purchase an investment property using mortgage debt, we have to plan for this. There's no, it is extremely rare for a self-employed borrower to present me with their tax returns and I say, awesome, you're approved.
Right.
It's usually, we have to sit down, have a conversation with your accountant, with your team of advisors, and get things basically worked out. Because most people want to pay as little tax
Right.
as possible, which is great, so long as you're not trying to finance real estate.
And that is especially true with SCorps and partnerships, LLCs, because at least a self-employed individual, and I mean the barbershop guy down the street, he's found a Schedule C, it comes through his self-employment income, that's basically income.
Yeah.
But the problem is the SCorp and the partnerships, because they don't necessarily have to pay themselves, and they don't.
Yeah.
And it can be, not only can be an issue if the IRS ever checks it, but it can be an issue when you go for a mortgage. So you, like you say, you have to know in advance from both myself and from your mortgage broker, when are you actually going to try to buy a home? When are you actually going to try to buy real estate, investment property? When are you going to be involved in this project so we can at least structure the return such that we can have our cake and eat it too?
Absolutely. So, okay, so is there like a maximum quote unquote number of deductions somebody can take on their tax return?
No, take as many as the code allows.
Okay, so could they show a loss every year?
Sure.
And then as a business owner, if they had a loss carry forward every year, at some point that has to end, right?
Correct.
Because the government's not going to allow a business to continue operating in the negative.
Yeah, so what the IRS says is that if you have a loss the first 2 years, the IRS pretty much says, okay, you're a new business, we understand, we're probably not going to question that loss. If you have a loss in year 3, year 4, year 5, the IRS will try to call you a hobby, which means you can't write off the loss, and at that point the burden of proof moves from the IRS to you. And there's actually, not get too far in the weeds, there's actually an eight-step process we look at to determine if a business is really a business.
Got it.
Obviously, do you have business cards? Do you actually see people? Do you have another source of income? There was a case recently, and I think about 5 years ago, there was a business who had been around for 25 years and never had a profit. And the
Wow.
IRS went after him for a hobby, and I think it might have been the horse industry, which they love anyway.
Yeah, there you go.
But he proved he was able to meet the 8 steps that the IRS guidelines, and he was able to prove, hey, it's just a bad business model,
Yeah.
but I'm in business, and he won that case. So
All right.
but after year 3, the burden of proof falls to you to prove that it's a profitable business. And let's be honest, you know this as a business owner yourself. If you haven't made a profit by year 5, unless you're Amazon,
You're not.
you're out.
Yeah.
Because your spouse is going to say, you know what, I'm getting tired of supporting you. I like to eat.
Yes.
I like to buy a new
Yes.
suit coat. It gets to a point.
Absolutely.
But it can happen. There are cases where, you know this in real estate, with certain, real estate is heavy in deductions that aren't real accounting deductions, amortization, depreciation,
Yep.
things of that sort. So we can produce loss in real estate for a long period of time much easier than that corner barber store.
So I just had a client I had this conversation with on Friday. They really blew their mind. Great couple, lots of student loan debt,
Mhm.
like lots of student loan debt. Like I'm talking $450,000 of student loan debt. And now they're going to work in the public, sector, so that debt is going to be forgiven after about 10 years. So
Okay.
I'll stay there for about 10 years,
Mhm.
which is fine. That's how the programs work. But the thing that they wanted to know is, well, how do we limit our tax liability so that we can, live? We were paying all this money for the student loan debt. Well, one of the things that they were thinking of doing was leaving their house, keeping it and renting it, and buying a new one. And they were like, well, we're sitting on a little, maybe more than $30,000 of equity, so let's sell the house, get the equity, and buy the new one.
Mhm.
And I said, well, I don't think that you need to have 30 grand to buy the next house that you want to buy. And after we did the math, they needed about 20 grand.
Okay.
And they had about 20 grand saved. So to go towards a purchase. So what we talked about was, well, what if you kept this house and rented it out? What would it look like? So this is a perfect segue into depreciation. So owning real estate, like residential real estate, has a useful life of what, 27 and a half?
27 and a half years.
So if you bought a home for $27,500, when I say home, a 1 to 4 unit residential property, $27,500 purchase is depreciable over 27 and a half years, so you would be able to deduct $1,000 from your taxable income.
Pretty much, real estate is what's called straight line depreciation, so although there's a little bit of variance, you're right, whereas versus if you bought a car for a business, you can depreciate almost all of it the first year, if not maybe 50%, then it goes down from there. But you're right, real estate is and that is strictly a deduction that has no basis in cutting a check for $1,000.
Correct.
It's the fact, no, it has basis in the fact that all assets waste.
Yes.
The building over years needs to be repaired. A car isn't as valuable, so there is economic justification, but it's one of the many benefits of rental property, because there's the other aspects of rental property that gives you additional deductions that wouldn't be there on a personal residence. You have your insurance, you have your utilities, you have your repairs, you have the travel back and forth, you have depreciation. Some of them are real costs, some of them are accounting costs, but that's the real benefit of rental property, is those below the line deductions that you either don't get or get after your taxable income is determined, now is above the line, and you get a dollar for dollar reduction in your taxable income.
Yeah, so that could mean, like with this couple, for what they could rent their 2-bedroom, 2-bath out for, I think that they have a net profit of maybe $200 a month, cash on cash, right? Like cash basis, she makes $200 a month. After accounting deductions like depreciation and property management and the other things that they would need to do to manage the investment, I think it worked out to be they were going to end up saving. They would effectively have almost a $4,000 loss on that property for the year, and that $4,000 in their tax bracket turned into be about, give or take, a $1,500 cash benefit to them. So they got to keep the $200 a month, $2,400, plus they got a tax benefit of filing of about $1,500. So $3,900 a year is what you would earn on that investment.
Yeah, the goal of rental property is, especially in the beginning, now after 27 and a half years, your mortgage is probably paid off, depreciation goes away, but the real benefit of rental property is it's going to be, if you do it right, is positive cash flow and a tax loss.
Yes.
And that's really what rental real estate, whether it's commercial, whether it's 1 to 4, 4 to, over 4, whatever it may be, that's the real, and that's the goal. The goal of the CPA is to produce a tax loss, but positive cash flow. Even if that cash flow is, as you say, $100 a month, because remember, the tenant is paying the mortgage, the tenant is paying the insurance, the property tax, they're paying all of the PITI, principal, interest, taxes, and interest. And if anything above 0 is actually gravy for the real estate owner of the property, because you're also getting the other things that go with it, appreciation of the property. You only put down 20%, so you've got the leverage value. So it's just the value of rental property is just huge. Yeah, there's some hassle to it. You and I both know, we both have rental property. If you do your own management, which I don't, I pay someone because I don't have time. But it's worth it in the long run, especially that when you get that one good tenant, and that tenant just stays and stays and stays.
Yes.
And when that happens, boy, you just look up and go, thank God I got a good tenant. Because when you have those bad ones,
they're brutal.
Yeah, I have one that I started off really rough. It's a single family. It's just a little property. But I finally got myself a good tenant, and we do, and my manager and I do everything to keep that person happy. They pay every month. They never hassle. Every once in a while they'll call, I understand that, but they're just a great tenant.
Good.
And you don't want to lose those.
No, you keep that one.
They're
paying off the mortgage for it.
Yeah, and we still raise the rent, $10, $20 a month just to show him, a year to show him we can.
Yep.
But, and thank God that she kept her job during COVID, because right now to be a landlord during COVID
brutal.
Can be tricky.
Yeah, so there's a lot of, eviction issues. We have a client actually right now who lost her job, wasn't able to make her rent payment as a tenant, and saved the money that she could, paid the landlord back almost $6,000, like 5 months worth of rent, And then as soon as she gave him the check and the check cleared, he told her, I'm selling the property, it's time to move out.
Oh,
Because he knew that he couldn't evict her anymore,
right,
right? He's like,
Right.
I gotta get rid of the property.
yeah,
So that's the only way that he could get rid of the property was to effectively tell her he's leaving, he's selling the property, and she was on a month-to-month lease at that point.
right.
So she's kind of stuck.
Unless the new owner wants to put her on a lease.
Now because he's gonna sell it owner occupied to get the most money.
I got you.
So, interesting, right?
Yeah, that's a tough one.
Yeah, it definitely is. So, all right. So, as far as here's a common question I just thought of: can you depreciate the home that you live in?
No, you cannot.
Okay.
And I did, like anything in accounting, I should actually say it depends.
It depends, is right. There's always
Yeah.
a discipline.
So if you have a home office,
Mhm.
and you're a sole proprietor, you're not an S-Corp or partnership, technically you can depreciate that part of the building that houses your business, whether it's your little 10 by 10 office. I had a client who actually wrote off half his house because the second floor of the studio, he was an artist, and the first floor where he lived.
That makes sense.
Or maybe you have another friend who is rehabbing a house at the same time as he's renting out parts of it.
Got it.
So the answer is yes. The problem is, in the long run, it really doesn't benefit you, because when you sell the house now, that part that you depreciated is no longer available for the Section 121 exclusion. And I'll come back to that in a minute, but it means that you're going to have to pay tax on that depreciation. So normally I don't depreciate a home office. Now between you, me, and fence posts, the IRS would say you have to. I don't, because it's not worth it.
Yeah, it's a small amount.
Unless it's like that gentleman who has half the house.
Yeah,
Or the gentleman, one of my clients, who has a garage that he stores his truck and everything.
that makes sense.
But if it's a little 10 by 10 like I have in my home, I never depreciated that. It wasn't worth it.
Okay.
Because what the 121 exclusion is up to $500,000 gain on the sale of your personal residence is automatically excluded.
As long as you're married, right?
As long, married, 250 if you're single.
Yep.
And there's a 2 out of 5 rule with some limitations, some caveats. But you would have to, let's say for example, you depreciated $100 a year because of a small office. You did it for 20 years. $2,000. When you sold your house, you had a $2,000 gain. Now, it's not a big deal maybe. You'd say, well, look at the benefit I got during every year. What's the benefit on $100?
Not
Very
a lot.
little.
No.
So it's not worth it. So we try
Makes
to
sense.
avoid it unless it makes economic sense. But the answer to one of my many long-winded answers is yes, you can.
So
but
long as.
you use it judiciously.
Got it. So we have a lot of clients that will want to buy rental property, and especially clients that are young, like early 20 to 25 years old. They'll buy the property owner occupied, which we can finance it as an owner occupied loan, and then maybe a 2 or 3 or 4 unit, so they can live in one unit, rent the other unit out, and then that'll pay for the majority of the housing cost, right? After a year of living there, they'll want to go out and then go buy the next property. So after they move out and they buy the next property, then they can start depreciating it.
Well, in that situation you used, and that's a little different than a home office, because like you say, I do have a client who did that, bought a two flat in the area here, and the bottom floor is rented out. He lives in the top, plus he has a home office.
Yep.
So all the expenses of the building are prorated, but that bottom part, he can depreciate because it's true rental property.
Totally.
Nothing wrong with that. And then we take the home office for the second floor, but we don't depreciate it.
Gotcha.
But when you have a situation like that, you still depreciate the rental side.
Yeah.
Because in that case, I would not say no, because if he's ever audited and he didn't depreciate it,
That'd be a
and then
problem.
he sold it, and again, it rarely is audited for this, but if you sold a rental property and the IRS audited you and you didn't take depreciation, they would come back and say, well, you didn't take it, but you should have, so now you have more gain subject to tax.
Got it.
So in that situation you're talking about, we would always depreciate the part that's a rental unit. We might just not depreciate that little home office on the second floor.
That makes sense.
Yeah.
That makes sense. So, okay, good. So this is really useful, I think, for me. A question for you. So one of the pieces of advice that I give self-employed borrowers, especially this time of year, is get your tax return prepared. Don't file it, and let me review it before you file it. Would you agree with that?
Correct. I mean, if you're going for a mortgage, and in some cases, you know that in some cases the bank will take a draft return.
Yeah.
Now, they will probably request a transcript later on, but in many cases, they may not. So we always, in our situation, if I'm working with yourself, or I'm working with a client who's working with a mortgage broker, we always say, let's get you a draft, take it to your guy, because maybe we can make adjustments that aren't terribly tax inefficient.
Yes.
To make, you and I had a client many years ago, I remember, we took the draft and you and I sat down and we were able to do a shareholder loan that created interest. We did a year-end bonus because of the SCorps.
Yep.
We did enough that she was able to get the mortgage she needed. Now luckily, if you remember, she was doing a 50-50.
Yep.
But by you and I looking at the return and doing some little strategy and changing things, we got her the mortgage she needed without a huge tax burden.
Yeah, it was probably the lowest way. It was probably the least amount of income tax possible to show that amount
Right.
of income.
And she got what she needed, which was and she luckily she was only doing 50%, she was doing 50% down, so it made it easier.
Yeah.
But those are things you can do, but you've got to, because once that return is filed, other than amending it, you're dead in the water.
Well, and yeah, the last thing that I would ever want somebody to do is go and amend a return.
Right. We, again, talking about audit risk,
Yeah.
amending a return increases your audit risk. So I'd rather take a look at the draft, let's see what we can do. Like I said, can we do a loan from shareholders? Can we produce some sort of deduction that can be taken off or added back? Can we do a year-end bonus? You know, it's a lot of things we can do before that return is filed.
Yeah. Well, cool. Well, thank you for taking time out of your day to answer these questions and give us some tips. If you guys have any questions about anything related to accounting or would like to talk to Bob, please reach out to us. We'll get you his information and get you guys in touch with each other. He's an excellent resource and can absolutely help you. Thanks again for coming out, man.
Thank you for having me.
Of course. All right. Have a good day, guys.